What's up everyone, it's Kadi with MoneyVest. So in today's video, I wanted to talk a little bit about Tesla's biggest risk, okay? And this is not any competition, this is not interest rates, but this is the biggest risk that Tesla stock right now has. And I wanted to do this video because I think it's important for everyone to be aware of what's really going on with Tesla's valuation and why that's going to be a bit of a concern moving forward as we kind of, especially go into 2024, and we have no visibility on whether rates are going to be higher, lower, where they're going to be, right? So hope you guys enjoy this video and find it helpful. And I'll go over some examples on why this is such a problem and why some stocks are right now getting caught in the middle of this and how this has played out in the past. So again, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. I would really appreciate it. And link to our Discord and Patreon is going to be down below. 16% annual discount that's available until tonight. So after tonight, it is going to expire. And we've also got the educational courses if you want to take advantage of that. We've got the Halloween sale, 50 to 60% off, lifetime access. And this also does expire after midnight tonight. So coupon code is going to be Halloween with a link down below. So the biggest risk to Tesla at the moment, unfortunately, is going to be multiple compression. Okay, two words, multiple compression. And what that means is basically the multiple, which is where Tesla's trading right now, the valuation multiple, that possesses in itself a huge risk to compress down to lower levels. And there's a couple ways that can happen, right? So multiples can compress if earnings drop, right? And the price obviously drops faster, right? So if the price drops faster than the earnings, multiples will compress because price is the numerator, earnings is the denominator. And the multiples can also compress if earnings go up faster than the price goes up, right? So there's two ways that multiples can eventually come down. Number one is price drops faster than the earnings, or price just drops in general and the earnings either stays steady or flat. So we see the multiples compress. And the second option is the price increases, but the earnings grow faster for the company. Now, in any environment, in any world of trading and investing in valuations, we want the latter, right? We want the earnings to grow much faster, significantly faster than the price itself. And there needs to be a dislocation for us to take advantage of so that we can, I can buy Tesla at a lower price to earnings multiple, and earnings are growing at a very faster rate. And then eventually, when the price starts to kind of correspond well with the earnings growth, it's gonna be a potential gain. But what we don't want is the former, right? The price dropping as earnings either stay flat or they drop at a faster rate, which obviously results in multiple compression. And unfortunately, over the next 12 months, I think this is the biggest risk for Tesla, is the valuation risk with a higher interest rate environment and how much of a pressure that's going to put on earnings. And I'll show you some of the charts here that some companies have actually gone through this very process. So if you go over to PayPal, right? PayPal went through this exact same process of multiple compressing down significantly. So you can pretty much come back to where PayPal was back in 2021. The multiple at the time it was trading at was just a ridiculous 70 to 80 multiple, right? So this right here was the range within which it was trading for the longest time. Even until, you'll notice, until August of 2022, it was trading at 57, right? The reason for such a high multiple, even at that point, was because earnings had completely collapsed and the price did not drop fast enough to compensate for the earnings drop. You can see the net income over here just basically coming down. And as a result, we did see the price obviously get collapsed and price to earnings multiple compressing from, highs of 70 and 80 down to 57. And now we have just overshot to the downside to 14 now. So you can see it on the right here. It's trading at 14.2. So huge amounts of compression happening for PayPal here, as revenue has obviously continued to move higher, but the net income has been the biggest issue. Net income, earnings, bottom line is what Wall Street really cares about. That's the only thing that matters for Wall Street and institutional investing, is if net income holds up, if the earnings hold up. This right here is going to be end phase, and you can kind of see a very similar process where end phase at the time, previously has traded as much as 100, 230 times earnings. And like I said, there's a couple ways that price earnings multiple can come down, right? If the earnings growth is much faster than the price itself, then the price earnings multiple will come down. But because the earnings expectations now and the growth is now starting to level off a little bit, you can see that decline here in the September quarter, 27% year over year, and the expectations were also not that great. So we're seeing that leveling off in the earnings overall, and as a result, earnings decline, price will readjust to the actual multiple, and as a result, you're seeing this significant sell-off, of course, in end phase as the revenue's also leveling off a little bit. Now, in the future, and I may get some comments about this as well, it's possible that we may see something similar to NVIDIA as well, because right now it's starting to level off a little bit, and price earnings multiple has come down because the net income significantly spiked. I mean, if you just look at this chart, this is insanity, right? I mean, this is a 200% increase in the net income in the June quarter, which basically restored a lot of confidence among investors for of course, companies like NVIDIA, for AMD, and, significant growth in profits, which resulted in the earnings growing and the price earnings multiple getting up to over 252, but then dropping suddenly after the quarter because artificial intelligence playing a significant role in the overall company's profits. However, in the future, right, if we expect NVIDIA's earnings to not grow at 200%, which obviously is not sustainable, right? So if they start leveling off a little bit, right, and if we start to see, and you can kind of see this in the past, right? Why did NVIDIA drop here, right? What was the significance of NVIDIA selling off a little bit over 68%? Well, if you just simply take a look at the net income, right? Net income pretty much dropped significantly back then. And as a result, price to earnings multiple also did compress. At the time, it was trading at over 93, 94, settled in and bottomed around 40. So that was about a 50% compression in multiples. Why? Because price was coming down, net income came down also. So the price actually had to adjust for the net income dropping, right? So right now, if you take a look at Tesla, the problem is that net income is now starting to roll over. So we're starting to see a little bit of a pullback in the net income, which is in blue. Revenue is also starting to level off a little bit. So that's the yellow line. So you can see that it's starting to go sideways. And net income over the last couple of quarters have obviously, come down because of those margins getting affected with higher interest rates and price cuts. But the price itself has not really moved much, right? So if you take a look, we are almost at the same level as back in May. So this right here has been the range for Tesla right now. And, if you think about where Tesla was during the October and December 2022 low, we also had net income, which was, pretty high back then. So the price earnings multiple was actually quite far more reasonable for Tesla at about $100 per share. Right? And that's the problem. That's the issue. That's the risk that I'm referring to, is that October, December lows for Tesla, we were at a much better price earnings multiple for the company, which obviously made it look like it was trading at a much better valuation. And now we have pushed up to over 63. So in other words, we've gone from 30, 25, 30 back up to over 63. So that compression risk back down to 20, 25, if net income continues to kind of roll over a little bit, is a bit of a problem. So again, if net income starts to accelerate in 2024, if we start to see profits come in a little bit higher than what the expectations are, or we're seeing year-over-year growth, then it's possible that the price kind of holds up at these levels, considering that growth is still there, and we're seeing the price earnings multiple still relatively a little bit more expensive. But if net income starts leveling off here, with margins coming down, as unfortunate as it is, right? For Tesla, we've seen margins come down for 5 to 6 quarters in a row, and interest rates are putting a significant impact on the overall earnings or demand, for example. Then we need to be prepared. That's all I'm going to say, is like, I will be prepared for that margin compression from 63, 64, possibly back down to 25, 30 levels for earnings multiple. Now, if you come over to our valuation spreadsheets, the discounted cash flow model is probably going to be the most brutal model for Tesla, which is also like a growth company. And look, this is what growth companies, the biggest risk for any growth company is multiple compression, right? Because the reason why they're trading at a higher multiple in the first place is because there's a lot of demand for those stocks. There's a lot of demand for those companies because they're growing earnings at a very faster rate. So investors are willing to pay a higher price earnings multiple. Now, it's all about kind of the music is playing until it's not, right? In other words, we have to, with growth stocks, it's kind of an interesting analysis because you have to really understand when will the music stop, right? And that is to say that, okay, price earnings multiple are high until the growth is there. And once the growth starts going off, well, then you've got big risk related to multiple compression. That's happened with PayPal, that's happened with Enphase, that's happened with Upstart, that's happened with a lot of high-flying growth companies. Happened with NVIDIA, happened with AMD, happened with Meta, happened with and Meta is a great example, by the way. I'm so I didn't go over that, so let me just go over. So this right here is a great example, right? Meta went through the same exact process of net income starting to taper off, right? Because they were spending so much money on augmented reality, virtual reality, metaverse, all that stuff. So what did we witness? Huge multiple compression here, and you can see the price coming down. But then what happened after, right? Multiples expanded, right? Multiples expanded again. It went from like 9.8 to over 26 again as the price recovered, and we did see the net income rebound a little bit as well. So that's a great example of how much influence there is obviously on the price itself. Kind of moves in tandem with the net income and the profitability for the company each quarter, but more specifically the price to earnings multiple, right? And a few examples I want to give you is that, look, price can still go higher, right? Like it did over here, and multiples did still compress as long as the net income holds up, right? As long as the net income held up here, you can see that Meta's earnings held up here, price to earnings compression did happen even though the price was going up, right? So it really comes down to earnings, and if earnings start getting hit for Tesla on a year-over-year basis, then that, in my opinion, is the biggest risk, which will create multiple compression, which obviously will lower the potential price for the company. That's the biggest risk that any growth stock, any growth company really has. Now, if you take a look at Tesla's, intrinsic value, we've calculated it before, but 20% growth rate in earnings over the next 5 years, 25 times P multiple, which I think is a lot more reasonable, and a discount rate of 12%, margin of safety of 10%. I've got an intrinsic value of close to $127. I think it was closer to 130, 136, but we're in and around those prices for Tesla at the moment, which obviously would still mean at 36% currently overvalued from where my intrinsic value is on Tesla at the moment. So let me know your thoughts down in the comment section below. And just this, 57, 61, 63, this is the risky part about Tesla is, if we do see a multiple compression, man, that's going to be pretty brutal, because that's the same thing that's happened with, so many companies, so many growth stocks in the past, because the earnings didn't hold up as well, and then eventually started to kind of level off and then, roll over, which eventually does open the company up to huge amounts of risk related to that multiple compressing down. So let me know your thoughts down in the comment section below. Coupon code Halloween is going to be available until tonight, 50 to 60% off on these educational courses. As always, make sure that you drop a like, subscribe to the channel. Happy investing. I'll see you all in the next video.